Trading in financial markets is a complex endeavor that involves a multitude of factors, including economic indicators, technical analysis, market sentiment, and, most importantly, human psychology. One of the psychological phenomena that traders often encounter is the gambler's fallacy, which can have significant implications for their decision-making and overall success in the market. In this comprehensive guide, we will explore what the gambler's fallacy is, how it manifests in trading, and strategies to mitigate its impact. The gambler's fallacy is a cognitive bias that leads individuals to believe that future events are influenced by past events, particularly when those past events appear to deviate from some expected or normal pattern. It is named after the gambling context where it is commonly observed, but its influence extends to various aspects of life, including trading. At its core, the gambler's fallacy is a misinterpretation of probability and randomness, often resulting in flawed decision-making. To grasp the gambler's fallacy better, let's consider a simple analogy involving coin tosses. Imagine you're flipping a fair coin, and it has landed heads up 5 times in a row. The gambler's fallacy would lead you to believe that the next toss is more likely to be tails since you expect the coin to even out the results. This assumption is incorrect because each coin toss is an independent event, and the probability of getting heads or tails remains 50% for each toss, regardless of previous outcomes. In trading, the gambler's fallacy might manifest when traders interpret recent market movements as a signal that a reversal is imminent. For instance, if a stock has been steadily rising for several days, traders might assume that a downturn is due to occur because the price has gone up for an extended period. However, this belief is flawed since market movements are influenced by numerous factors, and past performance does not guarantee future results. The gambler's fallacy can manifest in various ways in the world of trading, and recognizing these patterns is crucial for traders to make informed decisions. As mentioned earlier, traders may incorrectly assume that a trend reversal is imminent simply because a particular trend has been in place for a while. This can lead to premature entry or exit from positions, resulting in losses when the trend continues or missed opportunities when the trend reverses later than anticipated. Overtrading is a common consequence of the gambler's fallacy. Traders who have experienced a series of winning trades may become overconfident and assume that their winning streak will continue. This overconfidence can lead to excessive trading, larger positions, and, ultimately, losses when the market does not cooperate. On the flip side, traders who have experienced losses may fall prey to the gambler's fallacy by increasing their position sizes in an attempt to recover their losses quickly. This can lead to a downward spiral of even greater losses, as they are essentially betting against the odds to make up for past mistakes. Some traders may enter or exit positions based on random criteria or gut feelings rather than a well-defined trading strategy. They might believe that a certain price level is due for a reversal, even though there is no logical reason to support that belief. This kind of impulsive decision-making is a hallmark of the gambler's fallacy. To address the gambler's fallacy in trading, it is essential to have a firm grasp of probability and statistics. Understanding these principles can help traders make more informed decisions and avoid falling victim to cognitive biases. The fundamental concept to remember is that trading events are generally independent of each other. In the context of the gambler's fallacy, this means that past market movements do not influence future movements. Whether a stock has gone up or down for the past week has no bearing on what it will do tomorrow. Traders should focus on assessing the expected value of their trades rather than trying to predict individual outcomes. Expected value is a statistical concept that considers the probability of various outcomes and their associated payoffs. By making trades with positive expected values over the long term, traders can increase their chances of profitability. Another important statistical consideration is the sample size. In trading, this relates to the number of trades or data points used to make decisions. A single trade or a handful of trades do not provide a statistically significant sample size. Traders should base their decisions on a substantial body of data to draw meaningful conclusions. Mitigating the gambler's fallacy requires a combination of awareness, discipline, and a well-defined trading strategy. Here are several strategies traders can employ to reduce the impact of this cognitive bias. A well-thought-out trading plan is the foundation of successful trading. It should include clear entry and exit criteria, risk management rules, and guidelines for position sizing. By adhering to a trading plan, traders can avoid impulsive decisions driven by the gambler's fallacy. Stop-loss orders are essential for limiting potential losses, while take-profit orders help secure profits at predetermined levels. These orders should be set based on a trading strategy's parameters rather than emotional reactions to market movements. Diversification involves spreading your investments across different asset classes, sectors, or instruments. Diversifying your portfolio can help reduce the impact of any single trade or asset's performance on your overall portfolio, making it less likely to succumb to the gambler's fallacy. Technical analysis and fundamental analysis provide valuable tools for making informed trading decisions. Technical analysis involves studying price charts and patterns, while fundamental analysis considers factors like company financials and economic indicators. These analyses can provide objective data to guide trading choices. Risk management is crucial in trading to protect capital and prevent significant losses. Traders should determine their risk tolerance and set position sizes accordingly. Implementing risk-reward ratios, e.g., risking no more than 2% of capital on a single trade, can also help mitigate the impact of the gambler's fallacy. Keeping a trading journal can be an effective way to track trades and analyze their outcomes objectively. It allows traders to identify patterns in their decision-making, spot instances of the gambler's fallacy, and make adjustments accordingly. The trading landscape is constantly evolving, and traders must adapt to changing market conditions. Staying informed about market trends, news, and developments is crucial. Additionally, traders should continually evaluate and refine their trading strategies to remain effective. For traders who struggle with overcoming the gambler's fallacy, seeking guidance from a financial advisor or a trading coach can be beneficial. These professionals can provide valuable insights, offer accountability, and help traders develop disciplined trading habits. The gambler's fallacy is a cognitive bias that can have significant consequences for traders in financial markets. It arises from a misunderstanding of probability and randomness, leading individuals to make flawed trading decisions based on past outcomes. To mitigate the impact of the gambler's fallacy, traders must embrace a disciplined and systematic approach to trading. By recognizing and addressing the gambler's fallacy in their trading practices, individuals can make more rational and informed decisions, increasing their chances of long-term success in the unpredictable world of financial markets. Remember, in trading, as in life, it's essential to base decisions on evidence, analysis, and sound strategy rather than relying on superstitions or flawed beliefs about randomness and probability.